Hello, and thank you for watching my content via social media, as well as my company's website at lendonia.com. Recently, several of you have asked me to shed some light on a banking crisis we're going through and answer a burning question, how it may affect the US real estate market. So let's take a closer look. First of all, the reasons for these recent banking failures are pretty numerous. For example, Silvergate and Signature banks have failed because they invested their clients' money in very risky Bitcoin cryptocurrency markets. Swiss Bank had their failure written in stone for over 10 years, and that had to do with poor management and downright scandals that surrounded this bank. Rest assured, in the past 10 years, that bank has actually went down from being at the top of European banks down to a position, I believe, 161. So you can say they had it coming. Deutsche Bank, on the other hand, has done absolutely nothing wrong. And the drop to their share price is largely due because the investors, unfairly so, were simply wondering, okay, is Deutsche Bank the next domino piece that's going to fall? And that brings us back to Silicon Valley Bank, or SVB. And the best way to describe what's happened to this bank is simply to imagine that you are running that bank. Back during pandemic, you took in an enormous amount of deposits, about $150 billion. And one thing we know about banks is you're not going to sleep on this $150 billion. You're simply going to hang on to 10% of this because you're required to do so by law, and you're going to invest the other 90%. But we are in the middle of a pandemic. What do you invest in? So you start looking, watching what the other big guys are doing, and you notice that a big guy, meaning the US federal government, the Fed, is investing and buying mortgage-backed securities. So you do the same thing. You seem safe for 30 years. Now, truth be told, interest rates are very low, 3%. So these financial instruments you purchased are only yielding you 1.5%, but at least you feel you are safe. And now we fast forward, inflation starts going up, the Fed increases interest rates, and that causes a lot of your clients, big corporate clients, to start withdrawing the money, demanding that you simply honor their withdrawals. They don't want to keep the money with you at 0% when they can go on a market, invest this money, and make a lot more by buying financial instruments that are yielding 4, 5, 6%. Well, the problem is you don't have that money. It's sitting invested on 30-year bonds. What do? Well, you're pressed for cash, so you offer them for sale. However, no investor wants to buy them because of the recent increase in interest rates. They can purchase similar instruments right now that'll yield 3, 4, 5, 6%. So there is no buyer. You're forced to sell at a huge discount. And in their example, they sold $16 billion and they lost $3 billion on that sale. The word gets around, it causes people to lose faith in a bank, the bank is cash poor, and it causes what we refer to as the run on the bank. People are withdrawing the money, money isn't there, and now your bank is insolvent. The question now is, are other banks in the US in a similar situation? The answer is yes. There's been a lot of banks that were investing in these bonds, they are hanging on to those bonds, and oops, do we have a larger issue? Well, we would, except for two reasons. Number one, the other banks have been watching and adjusting their portfolios as these rates were increasing. In the case of SVB, they actually parted ways with their chief risk officer in February of 2022, and they've allowed themselves to function for 8 months without that position being filled. Well, it turns out that these 8 months were the 8 months that they should have had somebody watching, because these were the very months that inflation started going up, and of course, the Fed started increasing interest rates. So that's the first dissimilarity. The second one is that the other banks are a bit safer. They have been watching, plus the government stepped in and announced a bailout plan, if you will, which of course is going to cost banks some money. They will have to borrow against that plan, borrow from the federal government to assure their balance statements, if you will. Now, because it's going to cost money, that is going to make the banks look twice at corporate credit. credit guidelines for corporations, for businesses are going to be a little bit tighter. So it's going to be more difficult for these businesses to borrow money and grow, which will slow down the hiring and expansion of various businesses across the country. Now, the paradox is that that may actually help inflation and in turn help interest rates for your clients, people that want to buy real estate. The bad news would be if the government hadn't stepped in, if these banks were allowed to fail, then you're looking at a massive collapse. Businesses cannot get money, their own money from these banks, not talking credit, just the money that have accumulated. And obviously, we have a massive, epic collapse of businesses across the US. Obviously, jobs are lost and real estate takes a huge, huge turn for the worse. But again, in my opinion, we're not in that situation. There's going to be some consolidation of smaller banks. So the bigger guys that have better access to this federal money are more likely to survive in a better shape. But, in principle, we are safe. And that is all I have for this edition of The Close Look, brought to you by Lendonia, where we deliver more than mortgages, where we deliver information, ideas, and lending integrity. Thank you so very much, and have a fantastic day.